All right, it's 2 o'clock. So 2 o'clock Eastern, I guess 11 Pacific. So let's get started with today's webinar. Learn how DSPs are benefiting from establishing their own insurance company. I'm your host, Randy Sadler. I'm also joined by my colleague at CIC Services, Tim Wells. We've also got Jeff Strum with us as well. Jeff is a DSP owner, owns his own captive insurance company. So we're thrilled to be able to work with Jeff and thrilled to see all of you joining today's webinar. I would ask you if you would keep yourself on mute unless you're coming off mute to ask a question. And we're ready to dive in. Tim, get us going.
Yeah, great. Thanks very much, Randy. What we would like to do is go through our slides. This will be some good high-level overview information for you on captives. And if you could hold your questions to the second half of the hour, that would be great so that we can work our way through the slides. And then, as Randy said, if you want to type your questions in the chat bar, or again, second half of the program, ask questions, and we'll be happy to field as many of those as possible. Okay, Randy. Next slide, just a disclaimer slide here. We are talking about captives. However, we are not providing you with tax and or legal advice. So Randy and I are with CIC Services. The acronym CIC represents Captive Insurance Company Services. We are a captive management firm, which means we form and manage captive insurance companies. And we do that for people like you, owners of profitable, successful mid-market companies. And we've been providing those services for nearly 20 years. The company's primary office is in Knoxville, Tennessee, the eastern part of the state, although we have people spread out all over the country. Our client base is national as well. We currently manage approximately 150 captive insurance companies. Most of them are domiciled domestically here in the U.S. among a number of different states. All right, next slide. So what we do in helping business owners own their own insurance company, one of the things we can help them do is insure underinsured and uninsured perils or risks. So, and that can be done a couple of different ways. We'll be talking about this in a few minutes, but there are many uninsured and underinsured risks within your company, primarily for two reasons. Number one, the commercially issued policies that you purchase, we're just simply never, we're not designed to purchase, or excuse me, not designed to insure certain what we call enterprise risks, which I'll be talking about in a moment. And then secondly, those policies oftentimes have gaps, holes, exclusions in them. And those exclusions, many of those exclusions may be covered by or insured by a captive. So the captive can also help you control, manage, and lower insurance costs, your commercial insurance spend. Insurance companies are also can uniquely benefit from certain tax treatment, tax incentives essentially that are in the Internal Revenue Code. We'll touch on those briefly. And captive insurance company, or CIC, profits. So as your captive is profitable, and we would hope and we would expect your insurance company to be profitable, much like Warren Buffett expects his Berkshire Hathaway owned insurance companies to be profitable, we would expect your captive insurance company to be profitable. And as it's profitable, and you as the owner of that profitable insurance company benefit from increased wealth. And a captive can also be a very robust asset protection vehicle as well. CIC services and our team members are frequently published in both industry periodicals as well as generally business publications as well. Many of these headlines relate to a litigation involving us and the IRS. It is important to note that we were the plaintiff, not the defendant in this litigation. It's also important to note that our case went all the way to the Supreme Court, and the Supreme Court unanimously, 9-0, agreed with us, as you can see by some of these headlines here in 2021. We've been recognized a number of times as an industry leader by our industry. You can see here U.S. Captive Review, U.S. Captive Awards. Most recently, we were recognized by our industry as Captive Manager of the Year in 2021. I have a few bios here, although I'm not going to go through all of them. I do want to highlight Sean King, as Sean is one of our company's founders and our in-house legal counsel. He is an attorney as well as a CPA with a master's in taxation. So I'll just highlight Sean here, but don't want to spend time on any of our other bios here. We'll work through those. We are going to be sending this information out to you, so you're welcome to review it at your leisure. So what is a captive insurance company? A captive is an insurance company, in a general sense, not unlike any other type of insurance company that you're familiar with, whether it be Allstate or Hartford or Zurich. Similarly, a captive insurance company issues policies, receives premiums, and pays claims. So that's the same thing that any other insurance company does, and that's what a captive insurance company does as well. One distinct difference between a captive insurance company and, for example, Hartford or any other large commercial insurance company you may be familiar with, is that the captive is going to be owned by the same economic interest or the same individual, the same party as the primary company or companies that the captive is insuring. Said another way, you own your DSP, you presumably would also own the captive. The captive could be owned by a trust or could be owned by another entity that you control, but effectively you would also own the captive, and the captive insurance company is only going to insure risks associated with your company or companies. And captives are not new. Captives have been in existence for decades. So what can insurance companies do? They may be most often associated with replacing commercial insurance. Commercial insurance, I would say, is defined typically as kind of what I refer to as the big three: auto liability, work comp, and general liability. So captives can and frequently do replace those commercial lines of coverage. They can also insure enterprise risks. I mentioned enterprise risks earlier. I'm going to be showing you those examples of those on a slide here in a moment. And enterprise risks are the focus of our conversation here today. Although we're happy to talk with you about, again, replacement of those commercial insurance coverages such as the comp, auto, and GL. Captives can also be utilized to insure warranties, issue performance bonds, address employee benefits, medical plan, or any combination of the above. So here's an illustration of some of those enterprise risks. What you'll see here in the middle section of this illustration are those commercially issued coverages that I was talking about, the first bullet point on the previous slide. auto comp and GL, also perhaps even property. These are going to be coverages that you're currently purchasing now. Typically, you're utilizing a broker to secure these coverages from a large commercial carrier. So we're not really so much going to be talking about those lines during our discussion today. We're going to be talking about enterprise risks. And we generally define enterprise risks as those perils, those risks, exposures that, again, are either uninsured and or underinsured. So what might some of those be? Well, you'll see those outlined here to the right and the left of that center column. I won't go through all of these. One important one, certainly, that I do want to underscore here is loss of key contracts. So all of you, assuming all of you are Amazon DSPs, you have a very significant contract with Amazon. That's a significant contract. If that contract were disturbed, canceled, terminated, whatever, that would be catastrophic. That would be fatal to your Amazon DSP business. So contract cancellation is not something that you can go to a Travelers, a Liberty Mutual, Zurich, whomever, and insure. If you go to your broker, your commercial P&C broker, and ask for contract cancellation coverage, that's something that they're going to have difficulty finding. In a similar way, loss of licensure, certain types of business interruption, broad form property that's used to kind of fill in some gaps and holes. Cyber, your captive, a prospective captive could issue an excess cyber coverage, even though you likely have commercially issued cyber coverage. Regulatory and legislative changes, again, not something that you're going to find out there in the commercial market. Do you have that exposure? Absolutely. Governmental bodies, regulatory bodies, whether they be state and or federal, could subject you to certain new regulations that are detrimental, prohibitively costly to your operations. In a similar way, a state legislature and or the federal government could enact legislation. A bill could be passed into law, which could be detrimental to your operation. So there are literally dozens of these types of exposures that effectively you are self-insuring by default because you're not formally insuring them.
Right.
Yeah. So this is just an example of a loss that is uninsured by your commercial coverage, and effectively what we're saying here is you're going to have to pay for that loss, that event, out of operations or retained earnings or savings. It's not a good situation. It's an uninsured loss. Conversely, what we're going to illustrate here in the next line is a loss that also is uninsured by your, if you could advance to the next slide, Randy, a loss that is uninsured by commercial insurance, but is insured by your captive insurance company. So it's, again, a $200,000 loss, but it is, that peril is going to be covered by one of your captive's insurance companies. So what happens is that loss is going to be addressed by your captive. The claim is filed by your DSP with your captive. The claim is reviewed, approved, and paid. And your captive, and Randy's going to talk about this momentarily, your captive is going to be backstopped or it's going to purchase reinsurance. So what's going to happen is within this arrangement, 51% of that insured loss is going to be paid by the reinsurance company. In this case, an example of a $200,000 claim, $102,000 is going to be paid by reinsurance, and 49% or $98,000 of the claim is going to be satisfied directly by your captive. Randy, we're 15 minutes past the hour, so excuse me. I'm moving into your space.
This is really worth noting. because we do have a client that was an Amazon DSP that actually lost their contract with Amazon. Now that's a very, fortunately they had FedEx routes and other, but that's a big loss. And obviously, you've still got to turn the fleet in and all the other things you have to do. And there's a lot of costs there. So they had this insured in their captive. They received $1 million claim approved, $1 million. And that million was paid by money they had set aside in their captive in a tax favored way. And then also by the reinsurance pool. So think about getting $510,000 of help when your back is really against the wall. Very, very huge for this business owner. All right, go ahead, Tim.
Yeah. So this slide compares two companies. So first, the similarities. Both companies have $500,000 of risk management spend available to them. Okay. Secondly, both companies are purchasing those commercially issued policies, comp, GL, auto, property. They're both doing that. And in the scenario we're going to be looking at, they're both going to have the same claims activity, $25,000 of claims per year. Okay. The difference is business one, we could characterize as your current situation, your DSP today. And you're taking that $500,000 of risk management spend and you're setting it aside for purposes of risk management, or said another way, a rainy day / when something goes wrong, you have that money set aside in your Fidelity account, your Schwab account, your rainy day account. $500,000 a year, we're setting aside for 10 years, okay? Conversely, business number two, again, has that same $500,000 of annual risk management spend. However, what business number two is going to do is they're going to stand up a captive and they're going to direct that $500,000 of spend to their captive in exchange for the captive issuing those approximately, 15 to 18 or so policies there that you see in the green background. At the end of 10 years, after each company has employed their $500,000 of risk management spend, the result is going to be, for business number one, $3.3 million in reserves, and business number two, $5.2 million in reserves. So the next slide, we're going to demonstrate how that happens, although for your benefit and mine, I'm definitely not going to go through all these numbers. Certainly something we can talk about later. There are three columns here. The first column represents business number one from the prior slide. Said another way, informal self-insurance, that after-tax Schwab account, Fidelity account. And you can see, again, the $500,000, 10 years, and the resulting $3.3 million there at the bottom. The other two columns represent business number two. Both scenarios have established a captive insurance company. The difference is the center column is employing as an investment strategy more of a typical managed portfolio investment strategy, resulting in the $5.2 million you saw from the prior slide. The difference is the captive on the right is employing a hedging investment strategy, resulting in $4.7 million, but still, again, significantly greater accumulation of reserves, $4.7 million versus the $3.3 million of informal self-insurance. So you can think of this as we've titled this slide, claims paying ability or loss reserves. This is the accumulation, just like, again, Warren Buffett's Berkshire Hathaway owned insurance companies. You expect for that insurance company to accumulate reserves and then invest those reserves. So on the next slide, what we want to show you is the distribution of those reserves. So at some point, you are going to want to take monies from your captive insurance company. You've accumulated millions of dollars in your captive. And so effectively, the same three scenarios here. And what we're doing is we're simply solving for, we're taking the amounts that you saw after 10 years, the 3.3, the 5.2, 4.7. And what we're solving for is, okay, how much of an annual distribution can I generate for 20 years in equal annual payments or distributions to you as the captive owner. So as you can see in the informal self-insurance, it results in approximately $350,000 of distributions annually for 20 years. The middle column, 397, but that third column, the hedging, the investment strategy with hedging, which I will also say is coupled with a proprietary, our proprietary exit strategy, results in over $500,000. And again, this is annually for 20 years. So a significantly greater take for the owner of the captive versus that business number one, kind of a status quo scenario, which is represented by the informal self-insurance column. And what the proprietary exit strategy does is it substantially mitigates the tax friction on the dollars coming out of captive, resulting in greater dollars to you. And that's exactly what's represented here. Okay, I think that's my last slide, Randy. I've left you with an entire 8 minutes.
Very good. Yeah, I was answering your question in the chat, but let's I'll come back to it and maybe we just answer the question for everybody.
Yeah, at the bottom of the hour.
Yeah. So the question is how would the pool cover loss of key contract for DSPs? And so that's a good question, and we'll definitely be able to address that. So Tim has covered how you can own your own insurance company and how a claim is paid and how a reinsurance pool helps cover that loss. And so what we're going to talk about now is, in fact, reinsurance. So to be, obviously, as Tim laid out, owning your own insurance company has some significant benefits. One of those benefits is the ability to be taxed as an insurance company, which is not special or unique to you owning your own insurance company. If you drive into any major city, look at the skyline, look for the biggest buildings. What are they? Well, probably the football stadium, the bank, and then also insurance companies. Well, there's a reason for that. Insurance companies receive premiums. They set them aside in a tax-favored way. And then they eventually pay claims. Now, in that time period there that they haven't paid taxes on the money, they've been investing and growing that money, right? And so that's a benefit that you can have as well on a smaller scale. And that's why owning a captive is so powerful. So, but we do need to make sure we are real insurance companies. So to do that, we've got to achieve two things. And this has been determined by the courts over time: risk shifting and risk distribution. And that's that can be done through several different methods. Now, the IRS has attacked insurance companies in the past, and they've gotten thrashed in court many times. Some of the larger cases would be UPS, Humana, Rent-A-Center, Securitas, and others. And so after many losses, they decided they better publish some safe harbors on risk distribution. So we've got Revenue Ruling 2002-90, 2002-89, and most of our clients that are involved in a reinsurance pool, as the few Amazon DSPs that we work with now are involved in the same pool, are sharing risk via a risk pool arrangement, which I'll cover here in a couple slides. Now, Tim showed you how a claim works and how the pool steps in. And so I'll show you again how the pool works. So Imagine that you are the shareholder business owner here of your DSP. Your DSP is on the left. Your captive insurance company is in the middle. And obviously you own both. You own your DSP, you own your captive. You pay premiums and transfer risk to your insurance company. It issues insurance policies back. You're now protected for the many things that we covered earlier that are very important to you. Your insurance company is then going to share half your risk with the reinsurance pool. In this case, the reinsurance pool I'm referencing is called Republic. It's in North Carolina. It's overseen by the North Carolina State Department of Insurance regulator and a trustee. And so it's going to share half your risk. And that's how, in the event that you have an unexpected loss, that loss is covered. Now you might say, well, that seems extreme. I just had a question. What if 3 DSPs were insured and lost at the same time? Well, one of the things that we do is we do have some degree of capping risk by having policy limits. We're not insuring your loss of DSP for $5 million. We have insured it up to $1 million though. Well, that means your captive is going to pay half that loss, $490,000 roughly, and the pool's going to pay $510,000. Well, that sounds like a lot, but if we take, let's say 3 did lose in 1 year, that's $1.5 million. Now, remember, we have 120 insurance companies in the pool today. And those 120 insurance companies, many of them are not Amazon DSPs. In fact, only a handful are right now. So what they're going to do is take that $1.5 million. We're going to spread that across 120 insurance companies. It works out to about $12,000 per insurance company. Now, are they happy about paying for you losing your contract? No. But all of them, I guarantee you, even though they're paying $12,000 of your loss, our average captive insurance company is paying $500,000 to $1.5 million in premiums to their insurance company. They're all saving typically between $200,000 and $600,000 in taxes every year. And so paying $12,000 for the loss of 3 DSP contracts is not going to stop them from participating in a captive. So now, the other question that was in the chat, which we should talk about while we're talking about pooling, is what if the frequency of DSP losses goes up, then the cost to buy that coverage is going to go up, right? So all the Amazon DSPs that are participating, that policy may cost a lot more because it's more frequent. Mathematically, that will balance out over time the impact of that coverage. So, I guess, behind the scenes, if you will, there are underwriters and actuaries that are calculating the risk, adjusting it every year. And what we have found historically is that our reinsurance pool has had a 5 to 10% loss rate every single year. Why? Because we're constantly adjusting it. The only year it was higher was COVID, and that year our loss rate was 20%. But even at a 20% loss rate, every one of our captives came out ahead mathematically because their tax savings was bigger than losses paid, even pool losses, and the cost, okay, even during COVID. So again, we'll constantly adjust the math to make sure that it's a win for everybody, okay? All right, very good. So this is just an illustration of reinsurance pool here, which I just showed you. So as a shareholder, you own your DSP. You also own your captive. It participates in the pool with 120 separate insurance companies, and they're not all Amazon DSPs. So that's very important because we're going to have really good sharing of risk. Now, what happens? This is the beauty of owning an insurance company. What happens to the assets in your insurance company that don't get paid out in claims or expenses? You keep it all. It's your money. And that is a wonderful thing if you sell your DSP at some point, or if you decide to walk away, or if you want to go insure other businesses. Frankly, your insurance company can do just that. You get to keep it all. All right, so what does it cost to set up and run your own insurance company? Well, it does depend somewhat on the size and complexity, but many of you are fairly similar in size and operational complexity. So, for most of you, your setup in first year is going to be $45,000. And then ongoing years, it's going to be about $47,500. Now, this is an all-in cost. So what does that mean? That means it includes the attorney that's going to form your C Corp, draft your policies. This will include risk assessor, who's going to do a third-party assessment, establish your business purpose. It's going to include underwriting, which is going to turn that risk into policies with appropriate limits. It's going to include actuaries that price that insurance. It's going to include us coordinating that, and then also getting your insurance license from a state regulator. All of that for $45,000. And then you might ask, well, why in future years does it cost more, like $47,500? Well, we have to do all those steps over every year to be real insurance, and we're also adding in tax and audit, right? So that's why it's up a little bit.
Yeah, I'll also comment, Randy, I just want to comment here as well. The 45 and the 47.5 is based on that 500,000 that you saw earlier in the slides that I covered, 500,000 of premium being received by your captive. We've also noted below here a range, and that range actually could be lower, or it could also be at the extreme high end. It could be higher as well. So we're just trying to offer what we think where the kind of range where most of you would fall into.
Very good. Thanks.
Yeah.
Yeah. Very good.
I saw a question there, Randy.
Yeah, we've got like 7.
Capitalization.
Yeah. Do you want to?
Which is on that last slide.
What's that?
Well, capitalization is on that last slide because I saw a question in the chat. There are capitalization requirements for captives.
Looks like 8 questions stacked up in the chat. So we're almost at Q&A time. We'll dive into all 8 of those. Yes, the very first year only, your captive will require some capital. This is not premiums used to purchase insurance. So that is correct, Tim. And probably the better way to think about your captive typically is for most DSPs, your flow of funds to start your insurance company would be as follows: say $45,000 to form your insurance company. Probably 25% of your first year premiums as capital. So let's just say your premiums are $500,000. That's buying insurance to protect your DSP. Then plan on $125,000 capital. Much of that can be a letter of credit, which will allow you to free it up later. Okay, usually $25,000 cash, $100,000 letter of credit. And now you're insured and protected, right? And you're also benefiting from asset protection, also benefiting from ideally, tax savings of owning an insurance company. Those are all huge wins for you. So what would be your next steps? Well, first of all, you could engage us to do your risk assessment. And then a captive analysis report, that's $5,000 engagement. Then we'll have a third-party risk assessor assess your business, review that risk assessment with you. If you're ready to move forward, then we move forward to the actuary step, where we're actually pricing out your insurance and seeing what insurance you can purchase. So that's really the next step down the road. We're a little over time here. So what I'm going to do is, this shows you what a risk assessment will look like. It'll identify all your risks.
And Randy, I just want to point out on the prior slide there, the $5,000 for the risk assessment, $10,000 for the feasibility study. Those fees are included in the first year setup cost. And there's actually a step before step 1 here, which is a customized what we call ERM, Enterprise Risk Management Review, that we will do for you. I would send you a questionnaire. You would fill out that questionnaire, and that would allow us to create the customized Enterprise Risk Management Review for you, which I would then present to you. And then at that point, if you wanted to engage us, you could do so.
Yeah,
Thanks,
very
Randy.
good. Yeah, we don't have to go straight to the first step with the 5,000 engagement. We can build a model for you off of a questionnaire. And if you will send either Jeff or Tim, and Tim's email is right here, just a note saying, send me the questionnaire, then we can prepare a model specific to your DSP based on your geography, based on your history. All right, good. So we've hit Q&A time. We've got, looks like 11 questions in the chat. So let's just take these one by one. And then feel free to type questions into the chat. Let's see here. All right. What do these tables look like when you have real claims? 25,000 a year is Okay, so yeah, I kind of walked through that already. Is basically like assuming it's a zero loss. Yeah, we fed real claims every year. Loss of, I mean, as I mentioned, we had a DSP that actually lost their DSP, and the captive paid $1 million. During COVID, we paid out $15 million of pool claims. Nevertheless, all the members in the pool still came out ahead mathematically. If it would be helpful to have a very specific call on that, I'll be glad to do that. But just to give you just some raw math, across the 120 insurance companies in the pool, the average premiums are about 800,000. That's $96 million. $48 million goes into the pool. So even in years where we have, say, 5-10% loss rate, you're looking at $4 to $10 million roughly paid in claims, and still those that don't have claims come out ahead mathematically. And I've been here 11 years. We've never not had somebody not come out ahead mathematically, even with pool losses paid. Okay. Can you focus a deeper discussion on the example of the client that lost their contract, made $1 million claim? Okay. The DSP program is less than 10 years old. What would happen if the DSP is only part of the captive for 1 or 2 years and has lost a key contract? Yeah, I mean, that's why you buy insurance, right? I mean, we've got, like I said, we have 120 insurance companies in the pool, and we're adding more every year. The actuaries are very carefully pricing out the risk of every coverage using some pretty extensive math modeling. And so you're right. If you owned a captive and you lost your DSP in the first couple of years, you're getting a big payday, right? On the other hand, we have clients that have owned a captive and gone 10 years and never had a claim, right? That's kind of how things work out. As long as the actuaries are doing the math correctly, and we look at that very closely, then over time, pricing gets adjusted based on the likelihood of a loss for every line of coverage and based on the business and the geography. And as long as we keep making those adjustments, the math will continue to work. If for some reason we reached a point where DSP losses were extreme, then that may be a line of coverage we can't insure anymore. Just like any commercial insurer would do the same thing, right? Okay.
Yeah, and I also like to note that the underwriters and actuaries that we use, or the firm that we use, at least most commonly, is an actuarial firm that has been called upon by the IRS as a subject matter expert in U.S. tax court cases. So we feel very good about the underwriting and pricing of the premiums.
Yeah, very good point. Very good point, Tim. How much collateral is required? That's a good question. I mean, normally it's the initial capital. So if you pay 500,000 premiums, the regulator is going to typically require initial capital of 25% of first year. So that would be 125. So let's say you've got 625 in your captive. You can actually cover your half of a $1 million claim, right? So that's one way to think about it. Now, if you had a smaller DSP, maybe you bought $300,000 of insurance. Then the regulator is going to also require, let's call it 75,000 of capital, 25% roughly. And your policy limits are going to be lower, maybe 500,000, maybe 700,000. You're not going to get $1 million limit when you don't have enough money in the captive to cover your half. Okay. So your first year premium plus capital is going to kind of drive what your policy limit can be. All right. Good. What is the membership time requirement for getting full coverage if you get clipped early? Okay, very good. You join or clip by Amazon in 6 months. Yeah. So there's not a true time requirement. What we're doing is we're mathematically pricing your risk. Now, obviously, if you're early, your risk's a little higher. If you've got a long track record of staying in the program, having good loss history, over time, your premium pricing will come down a little bit, right? Just because you're showing less likelihood of a bad event. So there's not a true membership requirement, for lack of a better term. Okay.
But whether your premiums are high or low, I mean, your insurance company is capturing all of that premium. I mean, it's helpful to look at it from the perspective of you as the owner of the insurance company, because that's exactly the case. You're the insurance company. So all of the premiums that your DSP is paying are being taken in by your captive insurance company.
Seems like DSPs in this pool would blow it up as our key customer risk is so high. Yeah, we'd have to mathematically determine that. We don't have enough experience yet with that. Again, I think we could. It may be worthwhile to do a quick poll and just see, what that risk actually is. I know we have priced that historically and mathematically. Again, we don't have enough DSPs to know that but mixing it with the other risks in the risk pool, we haven't been alarmed. I'd say that, and nor have the actuaries, quite honestly. All right, are all captives in the logistics space? No, good question. So the captives that we currently manage are from California to Washington State to Vermont. Don't have any in Maine, by the way, to Florida, in a wide range of industries. Most actually are in construction, medical, and a lot of import, export, some service, and then some tech companies. The number that are in distribution right now is about 15%. What's that, Tim? You gonna say something, Tim?
No, I was going to say tech as well. IT.
Tech, yes. Yeah, tech companies, it's definitely challenging for them to find insurance because their risks are very unique as well. Okay. All right, good. I own a DSP where it's only 10% of the activity. The rest of the business is different. Yeah. So I think you're asking, can you insure other businesses? The answer is yes. Many captive owners have multiple businesses and they insure all of them through the same captive. So I'd love to talk with you about all your businesses and see if a captive can serve those as well.
Also, Randy, I kind of forgot, we're going to have Jeff say a few words, not to put you on the spot here right at the moment, Jeff, but we're going to do that at the bottom of the hour, but we forgot. So if you want to say a few words, Jeff, give us a break for 30 seconds.
Yeah, actually,
you're live, you're on.
Yeah, these questions are probably more important than me talking, so I'm gonna let you guys go for now.
Okay. All right, that sounds good. Is this in addition? And this is in addition to the yearly premium of $500K. If you added more businesses, likely the premiums will go higher. Yes, very likely. By the way, we're using 500 as a number because the few DSPs that we've worked with, that's about where their premiums have landed. You can always buy less insurance. It's a variable cost. So you could say, I only want to buy 250. Well, then let's pick the policies that are the most important or lower your policy limits to make that work. So you're not locked into 500. Okay. Does this require DSP to be all in, including liability, work comp, auto? Normally, you're going to have auto liability and work comp outside of the captive. And for several reasons, the main one being state requirements. Your captive is not rated or admitted, most likely in your state. You could earn that rank over time by building up enough money in the captive, and then we go to your state and get you admitted. But normally, you won't be what's called an admitted carrier in your state. So work comp, auto are really kind of the two that are very difficult to put in the captive. So plan on them staying in the commercial market. General liability, we've covered that before. That's your call. If you want to look at that in the captive or not. Your Amazon contract may require that be with a rated carrier, in which case you won't be able to put that in the captive either, at least not at first, okay?
I would say if you have combined GL, auto, and work comp spend annual premiums in excess of $500,000, then we can have a conversation about that. But if it's less than that, there's not going to be an opportunity to replace it. However, we could look at if your losses have been low, maybe less than 30% over the last 5 years, good loss history, then we could look at potentially increasing your deductibles, thereby lowering your premiums. and covering that new that first layer, that new exposure within the captive with a deductible reimbursement policy.
Yeah, very good point. DSP ownership does not allow partnerships. Does this? Many of our clients are partners. They may be partners in a business, partners in multiple businesses, and partners in the captive. Hopefully that answers that question. Can you talk about tax implications? I see the insurance premium from the P&L, but when the captive pays back or is dissolved, what type of taxes are involved? Does it cancel out the initial savings? It does not cancel out the initial savings, actually. And I think Tim shared that here. So there's several ways to exit out of your insurance company. One is to just pay a full capital gain, which is this column in the middle here. So you see, even paying a full capital gain and taking the money, you're basically exit out 7.9 million instead of 7.0 over time. So that's a pretty significant difference. However, there are many exits that are more tax efficient, and this is over here on the right. You see a strategy where we call it hedging, basically, and you utilize a life insurance policy along with the ability to borrow money out over time, and that'll in this case 534 a year for 20 years versus 397 versus 350. So that creates a whole lot more money. So there are other exits that are also efficient, like converting your captive from a C corp to an S corp, and then using that to generate income. So there's a pretty wide range of exits, and just about every circumstance you should come out ahead versus where you would be not having the captive. All right. What portion of premiums are paid to the captive versus the pool? Okay, yeah, good question. So nice thing about risk pooling, which is very different than buying, when you normally buy reinsurance, the money's gone. When you pool, the money comes back that's not used, right? So if you paid 500,000 in premiums to your captive, roughly 250 would go to the pool. Every quarter that would come back as the actuaries released it. If we had a normal claims year, of the 250 that went to the pool, 225 would come back, roughly 225 to maybe 200 would come back. So at the end of the year, and that's really what we model in this slide here, is those pool claims getting paid on 500,000, and then you've got 5.2 million over that 10-year period versus 3.3 without the captive. So that's a good question. With the new insurance updates by Amazon to the 2023 program, policy requiring insurance companies to be verified as admitted status directly with the agency for the states we operate in, are the captives set up to be licensed and admitted? I suspect your Amazon admitted requirements are on work comp and auto, possibly on general liability. So that would definitely be worth looking at your contract on what they're requiring to be admitted. And so very often contracts require admitted insurance for, say, liability, maybe property, auto, or comp. So I think you're going to find, and be happy to review the contract with you, that other coverages for things like, say, cyber or things where the risk is to you and not to Amazon, which is what your captive is going to insure, that they don't have those requirements in place, like receivables, loss of contract, government interference in your business. Those are things that you're not even insured for now, most likely. Okay. Are there reasons that would disallow a claim being paid out? Also, for secondary businesses, how does a business prove that it was a loss of a contract if there's not necessarily a notice of cancellation, but a client just stopped using your company? So this might be outside of Amazon. That's a good question. So first and foremost, your captive is a real insurance company, just like any other insurance company. So it's gonna be treated the same way. So when there is a loss, one of our roles as manager is to contract a third-party claims administrator. Just like if you have a wreck today and an adjuster comes out, we're going to do the exact same thing. And so that third-party administrator is going to look at the policy language. They're going to look at the loss on the ground, and they're going to approve the claim, or in some cases disapprove it. When would they disapprove it? Well, it's not covered, for one. Sometimes there's things that aren't covered. Your captive policies will be much more broad than commercial policies, which are full of exclusions and all the times they won't pay. But there are many times that the captive will pay, much more than your commercial policies, frankly. And then when the third-party administrator adjusts the claim, they may not agree on the loss amount, for example, but very rarely have we had anybody that had a claim and it wasn't paid and paid in full. And unless they were really late filing it, there is a window to file your claims, or they just simply weren't covered. Okay. And then how do we know about loss of key account? It does need to be a contract. So if somebody's buying from you and then they just stop, unfortunately, that's not insurable. So you do need to have some kind of contract in place, okay, or at least some type of operating agreement. Good question there too. Please explain where the claim administration would be handled. Okay, I think I covered that. Third-party administrator, we currently use Sedgwick. They're a global claims administrator, so they can administer a claim anywhere in the world, theoretically, but certainly anywhere that you're operating, okay? All right. Okay, let's see. 2023 program policy requiring insurance companies to be verified as admitted. Did we already address this? Or is that new?
No. Well, or it may be a different question, but it's
Okay.
asking the same thing.
Are the captives set up, licensed, and admitted? Yeah. Yeah, again, you could get your captive admitted. It would require a lot. It would require a lot of cost, frankly. And most captives that support small, mid-sized businesses are not admitted, for the simple reason that you're not writing auto, work comp, and those are the coverages the state cares about. And what I mean by that, in auto, if you run over somebody and hurt them, they want to make sure they get paid. Work comp, if a worker gets hurt. If you lose your contract with Amazon, the state doesn't care. If you get fined, the state doesn't care. So if you think about it, the policies in this captive are really protecting you, right? And so where states require insurance to be admitted is when they're protecting somebody other than you. Okay. So, the goal of the captive is to protect you, your business, your money, and help you not get cleaned out. And so, what's the legal structure? Yes, a captive does have to be a C corporation. All insurance companies do have to be C corporations. Now, when you close, you could convert it to an S if it's better for you. Maybe you've got some leave them as C's, some convert them to S's, some just close them. So yes, referring to work comp auto, perfect. Yeah. You'll need to leave your work comp auto in the commercial market. Now you can take a high deductible on your auto, and we can certainly insure that in the captive. Okay. So, and we've insured auto physical damage in the captive as well, if you wanted to insure repairs on your fleet. And I know your vehicles get banged up. So yeah, please restate coverages you have assumed are in the 500. My work comp is roughly 150, auto roughly 180. Yeah, so those numbers sound reasonable, 150, 180. So in the 500,000, it's really coverages. Again, these are common coverages that we have in place right now with Amazon DSPs, and I just dropped that. So let me move this over. Okay. So broad form property is going to cover anything your property doesn't cover. Example would be loss of access, loss of key employee. There may be key people in your enterprise that if you lose them, it's going to cost you money to replace them. Losing key contracts, losing any kind of business license that you rely on, any kind of business interruption to your business, which fortunately you guys did well during COVID. There's other businesses that did not, but there might be something that would interrupt you, like a massive fuel shortage and you can't deliver for 2 weeks. That sounds crazy, but it's certainly possible. This is contract risk, commercial risk indemnity, cyber, speaks for itself, receivables, especially if you have other businesses. I suspect Amazon probably pays you on time. Commercial crime, any kind of inside job, employee stealing from you, employee taking parts, stealing packages, whatever that might be. Physical damage for the fleet, we can put that in the captive if you want. We can insure cargo, although I suspect Amazon has some requirements on your cargo insurance as well. Natural perils is weather events that disrupt your business, regulatory legislative law changes that affect you, or regulatory changes. So government actions can create costs for you, disrupt how you operate, and you can ensure that. Reputation damage speaks for itself. Catastrophic is a kind of a wide scale business interruption. Residual value is a type of insurance that, especially if you own something and then you have to return it and the value goes down, and you've got to cover that lost value, that can cover that. Litigation, obviously, getting involved in any kind of legal dispute outside your liability policies. Tax indemnity would be errors in your tax return. Deductible reimbursement would cover any deductibles that you have on auto, for example, property, work comp liability. Administrative actions would be any kind of government agency bringing action against you. Directors and officers covers you and the officers in your company. Employment practices covers you against alleged harassment, discrimination, etc. So,
Randy,
Yeah, go ahead.
Yeah, I want to grab one of the questions I just saw come across from Ruben, I believe, which is I may have been misunderstood or I may not have communicated very well earlier. Because I think, Ruben, you're saying that your combined comp and auto does exceed $500,000 of spend. So yes, if you have low losses, which otherwise you really would not want to be, if your loss ratio is 80% or 103% or something, you would not want to consider a captive for comp and auto. But if you're spending in excess of $500,000 for comp and auto combined, then yes, we could certainly have a conversation about the captive replacing those lines of coverage. But again, if you're under 500,000 of combined annual spend, premium spend, we could still talk about addressing the comp and auto. However, we would not be talking about the captive replacing those lines. We would be talking about a potential deductible reimbursement policy. Again, as Randy just talked about, increasing the deductible on those policies in an effort to drive down your premium, and then taking that newly created exposure, so to speak, and ensuring that via a deductible reimbursement policy issued by your captive.
Very
How
good.
would we make it admitted, though? Ruben, yeah, thanks for the follow-up question. So there's something called fronting within a captive arrangement when we need an admitted and rated carrier. So essentially what we're doing is going out to a rated carrier, with an AM Best rating, a Travelers, a Hartford, a Zurich, whomever, and essentially your captive is contracting with that rated carrier such that that rated carrier, let's say Travelers, is going to issue that work comp policy, which then in turn is going to satisfy the state or states that you operate within. And then you're going to pay Travelers what we call fronting fee for, effectively leasing their AM Best A- rating, or whatever their AM Best rating is. So that's how we accomplish that. And that's really the reason for kind of that starting point of about 500,000, because anything under that, we can't interest Travelers or any other fronting carriers in talking to us for anything less than that. It's just not worth their time and effort. So good follow-up question, Ruben. Thank you.
Yeah. If Amazon does not renew your contract, is that the same as loss of contract? Yes. Okay, Ruben, we just covered. Is there a difference in treatment between contract cancellation and contract non-renewal? No, they'd be viewed the same way. And if we need to, we make sure your policy language makes that very clear. Okay. We don't spend on any of these coverages currently, so I don't understand how this program brings savings if the spend is new. Very good question from Ian. So Ian, remember, we're taking advantage of several things here. The first is owning your own insurance company. And so by owning your own insurance company, the first thing is if you had a surprise loss in any of these areas, let me find my slide here. Yeah, if you had a surprise loss, then obviously you're going to get half that paid by the pool. So that's the first benefit is the insurance. But the second is by owning your own insurance company. And obviously you'll need to consult your tax advisor, as do all of our clients, but you can elect to be taxed as an insurance company. And so by electing to be taxed as an insurance company, as Tim had gone through, if you took $500,000 a year and on the left, you just paid tax and saved it, you'd build up 3.3 million in 10 years. If, however, you took that same 500,000, owned your own insurance company and bought insurance versus just paying taxes and saving the money, you'd build up 5.2 million in that same 10 years. While adding all this additional insurance coverage. So that's really why there's a benefit to insuring risks that you're currently not insuring, is that you do in fact end up with a lot more money over time. So more insurance and more money. That's the promise of a captive. Okay. Okay. Ruben's question. Got it. How do we get it admitted? If we're under the 500K threshold, because we're a monopolistic state and our auto is just not that high, can we still be involved with the captive? Yes, you can be involved with the captive, Joe, on all these other coverages that aren't relevant to Ohio. Yeah, Ohio has that work comp rule where you got to buy it from the state, but they don't require you to buy all the other coverages from Ohio. So these other coverages could go through your captive. Would we need EPLI, or would this cover those instances? The captive does cover EPLI for many clients. Certainly that's Amazon may require you to have it with an admitted rated carrier. I don't know that, but if they do not, you can certainly cover EPLI in the captive. All right.
I just wanted to note.
Yeah, go ahead.
Yeah, I just wanted to note we're at the top of the hour. I don't have anything immediately behind this, so I can certainly stay on. And for those of you that want to stay on, please feel welcome to do so. Yes, I saw a question regarding the slide deck, the recording. Yes, we are going to be sending it out. So feel welcome if you need to jump off. Contact me. We can have a one-on-one call. I can get you the questionnaire if you would like us to do some customized financial modeling for your specific situation. We'd be happy to do that. But Randy, if you can continue to stay on as well, then we can continue fielding questions here for
we've got about a little bit longer minutes. Yeah, absolutely. Work comp coverage cover monopolistic state like Washington. So Washington, Ohio, both similar. Your work comp, the state's going to require you to buy it through them. However, other coverages can be purchased through your captive. So good question there. Sharing the slides. Yes, we will be sharing the slides. And we're recording it as well. Same.
Yeah, within a few days, I think Jeff's going to be sending it out, but it's also going to be posted on our website, which is captivatingthinking.com.
What Tim mentioned is if you've got a combined auto work comp spend to 500, then we may be able to get what's called a rated admitted carrier to insure that and reinsure that to your captive. So reach out to us. So let's look at it. On the other hand, when you're insuring enterprise risk coverages, like in this green box here, typically, if your premiums combined are 250,000 or more, then the captive almost always will be a mathematical win for you. So we'll be happy to send you an Excel questionnaire, have you provide some information on your DSP, and we'll model that for you. And then we can have a call one-on-one and really go through whether it's a fit for you or not. Good deal.
Guys, there's no cost to that, correct? Filling out the questionnaire and then getting it back to you?
That's right. The questionnaire and the models, no charge. Yeah.
Super.
Yeah, that's largely directed toward,
Yeah.
I mean, there is customization based upon the information we pull off the questionnaire, but largely we're just trying to help familiarize, educate, and acquaint you with the captive to a point where you can determine whether or not it's something that you would like to explore further. We just want to help you understand it better. No cost.
Very good. All right, it looks like we've answered lots of questions. Hopefully it's been very helpful for you all. We've been honored to spend the afternoon with you and talk about owning your own insurance company, protecting your DSP and other businesses as well, if you have them. So we'll be sending out the slides, link to the video. By all means, feel free to reach out to us with any questions that you have. I'm going to put Tim's email up here. You can reach out to him directly and schedule time with him to go through your unique situation. Good deal. Yep. Chris Bernard would like questionnaire step next. Awesome. Very good. And we'll be honored to work with all of you, and I really appreciate you joining us today. So with that, we will sign off.
Thanks, everyone.
Thank you so much.